Hello everyone and welcome back to MyFi Crusade, the channel where I share the tools and tricks that will help you gain financial independence even starting later in life like me. I'm your host, the FI Crusader, and today we're going to be talking about how to properly handle credit cards. So stick around and I'll show you how to avoid paying interest on your cards and how you can end up paying your credit card balances with the least money possible. So that you understand where I'm coming from, let me tell you a story about my past. I grew up in a lower middle class family with parents who were raising two kids. So I remember when I was around 10 or 12 years old, my parents filing for bankruptcy. And the amount of debt that they had on their cards, they couldn't pay it off. And this was kind of part of the whole system. This is what credit card companies do. They charge you really high interest rates. They do that so that they can continue to make money off of you. And this left me hating credit cards and feeling like they were a big scam and that I was better off without ever touching one. And if I wanted to buy something, I was just going to pay for it in cash or on a debit card. I didn't learn until later, much later in life, that this was a bad idea. There are protections that come with buying stuff on a credit card, related to identity theft and insurance things that you can get for things that you buy on credit cards. And in addition to that, I wasn't building up a credit history. When you pay for things with cash or with a debit card, there's no transaction tracking on that. There's nothing for a bank to be able to keep track of and see, yes, I'm paying things on time. Yes, I'm handling my money well. And that's something that you can only get with a credit card. You need to have credit cards in order to build a credit history. And without that, your credit score will just get in the way when you want to buy bigger items like a house and a car later in life. So what is a credit score? Well, it's just basically a system that the banks use to determine whether or not you're going to pay your debts or not. And this is how they determine how much of a risk you are for loans or for credit cards. Most companies will give you a credit card if you don't have much credit history, but they won't give you a very high limit. For example, your first credit card may have a $500 limit on it, and they do this to reduce their risks, but also to give them a chance to make some money off of you, basically. So let's not kid ourselves. Banks are not giving you a credit card out of the kindness of their hearts. They're a business. They know that if you get a card, there's a high likelihood that you're going to spend more than you have, and then they can charge you interest on the balance you carry every month. If you use this system, you have to know the rules. And if you know the rules, you can use the system to your own benefit. So how do you play the game and what are the rules? Rule number one, always pay your bill in full at the end of every month. Now, by paying your bill off in full at the end of every month, you'll never get charged interest for anything that you put on that credit card. And I can't stress this point enough. Never, ever miss a payment. But you can't pay off your credit card with minimum payments. So always pay it off in full at the end of every month. Now, you're going to say, well, why would they give us minimum payments if we can't pay off the card? Well, you can. You can actually pay off the card. But the way that these banks structure the minimum payment is pretty sneaky, honestly. They use an intentionally small minimum payment to extract the most possible interest out of you. They want you to carry a balance forever because that's how they make their money. Look at your most recent credit card bill. Since the Credit Card Accountability, Responsibility, and Disclosure Act was signed by Barack Obama in 2009, credit card companies are now required to show you exactly how long it's going to take you to pay off your credit card if you pay only the minimum payments. You're looking at 19 years to pay off that card. So paying your credit card in full every month is essential in order to avoid having to pay interest and basically pay money just to spend money. That's essentially what you're doing. You're paying extra money just so you can spend the money. And paying your credit card in full each month also helps you build a good credit history so you can increase your credit score. And this goes directly into rule number two. Rule number two, never spend more money than you can afford to pay off. Now, You might hear that rule and say, well, what's the point of having a credit card if you can pay for everything in cash? Well, the answer is simple. Credit cards give you the ability to pay for something tomorrow that you need now. And before you go and look at me and say, well, duh, let me explain. You get paid bi-weekly or weekly or monthly like I do, but your bills are always set up monthly. And if your bills take up half of your paycheck and they're due early in the month, well, that leaves you with basically no money to live on for the majority of that month. Enter credit cards. They let you buy groceries and gas and all the essentials for living without having to pay the bill right now. So the caveat is that you do have to pay them eventually, obviously. So you can use credit cards to spread out the cost of living over the course of the month. And in addition, they also let you earn perks for doing so. Things like cashback rewards and reward points. They let you earn something using the card for your purchases. And this can be very helpful in saving you money, which I'll get into in another video. But a card that gives you 5% back on, say, Amazon purchases, like the Amazon card from Chase does, will save you 5% on everything that you buy on that website. There are other cards that will give you a percent back on everything that you spend. Some have rotating categories. Some are designed specifically to help you with paying for travel or restaurants. And so there are all kinds of different ways that you can benefit from using the credit card. But the main thing is you don't want to spend what you can't afford. Period. Rule number 3, never pay interest on your credit cards. You're probably thinking, didn't we go over this in rule number 1? Or that's good enough if you don't already have a balance on your card, but what do you do if you already do? Well, yes, we did talk about this in rule number 1. And if you're following rule number 1, then you never have to pay interest on your cards anyway. But if you haven't been following rule number 1, and you haven't been following rule number 2, then rule number 3 can help you save a lot of money when you're paying off existing credit cards. So there are ways to avoid paying interest on credit cards, and they're 100% legal. Whether you already have a card with an existing balance or you don't have any credit cards at all yet, the best way to do that is actually to open another card. And you're going to look at me and go, wait, I already owe money on my cards. Why would I open another one? Well, the reason for that is there are credit cards out there that have specific offers. Offers like the one that I just picked up last month. There are credit cards out there that offer you 0% introductory APR, meaning 0% interest, for a specific number of months when you open the new card. I opened a Capital One Quicksilver card last month. I'll put a link in the description below. That has the following perks. 0% interest on any new purchases for 15 months. 0% interest on balance transfers for 15 months. You do have to pay a 3% fee on the balance transfer, but then you don't pay any interest on it afterwards. You earn a one-time $150 cash bonus if you spend $500 within the first 3 months of opening the account, and you get 1.5% cash back on every purchase every day. And it has no annual fee. So the one catch, and there are always catches, but the one catch with this one is that you can't have ever declared bankruptcy or defaulted on a loan. You haven't been more than 60 days late on any credit card, medical bill, or loan in the last year. And you have to have had a loan or credit card for 3 years or more with a credit limit above $5,000. That's it. If you can meet all 3 of those, then you qualify for the card. Now, Chase has a card, the Freedom Card, and I'll put a link to that below as well, which provides some of the same benefits as the Capital One card. This one also, 0% interest on new purchases for 15 months. 0% interest on balance transfers for 15 months, again with a 3% fee. You earn a $200 cash bonus once you spend $500 in the first 3 months. And it's 5% cash back on specific categories each quarter. And the key here is that you actually have to log into their website and activate the 5%. They switch categories every quarter, and you can get up to $1,500 back over the course of a year. Everything else earns you 1%. And again, just like the Capital One card, there's no annual fee. The only real difference between these cards is how they do their cash back, and the Chase card limits you to 60 days for that 0% balance transfer fee. You have to transfer the balance within the first 60 days of opening the account, whereas the Capital One card will actually let you make multiple transfers over the course of the full 15-month period, and they won't charge you any interest on those balance transfers during the 15 months from your account opening. So if you can qualify for any of these cards, then you can transfer your current balances to one of them and save yourself hundreds in interest. For example, let's look at just say a $4,000 balance on your current credit card. If you have $4,000 and you balance transfer it over to one of these new cards, either card at 3% is going to cost you $120 to transfer that $4,000. However, the card that your balance is coming from, they might be charging you 24.99% interest. And that would work out to somewhere in the neighborhood of $80 a month. $80 a month in interest. Now, you'd save money after the second month, and you could pay the card off in full in 10 months by paying $400 a month. In addition, if you were to actually do that $500 introductory amount, let's say in the first 3 months you spend the $500, you can make back another $150 to $200 just in their bonus for signing up. So that pays for the $120 fee that you transferred the balance on, and then some. You're making $30 to $50 on top of that. And that's before you even look at the amount of money that you're saving on interest. So this is how you can get credit cards to actually pay you just to use them, if you're disciplined enough to pay the card off in full in the 15 months. So one thing you're going to notice if you look at your credit card statement is that they're required to tell you how much of your payment goes towards principal and how much goes towards interest. And if you're paying the minimum, then a large chunk, if not most of the money that you're paying them is going towards interest. And that's just the way that they've designed the system. So this is why rule number 1 is so essential, paying everything off in full at the end of the month. However, if you've got a large balance right now and you just can't afford to pay it off in one big chunk, there are ways to avoid paying the interest, and balance transfers are one of them. The biggest benefit of avoiding that interest payment is it gives you more money to spend on paying down other debt. If you're paying $60 out of an $80 payment towards interest, that means that you're only paying down $20 of the actual balance that you owe them. And that other $60 is going to waste. So if you balance transfer onto a card that has a 0% interest, you're paying $100, all $100 goes towards the principal, the amount that you owe, and none of it goes to interest. And that's the biggest essential building block to getting financially independent, is finding ways to avoid paying extra money just to pay down your debt. Look at your bills now and look at those credit cards and how much they cost you just to maintain them. Rule number 4, do not close your oldest credit cards. One of the major things that credit score system looks at is the average age of all of your accounts. And if you close out the oldest credit cards that you have just because, you paid them off, it's actually going to tank your credit score. and it's going to tank it hard. Because if you get rid of the oldest credit cards, then your average account age drops dramatically. This basically means that you should never, ever, ever close your oldest credit cards. You should keep those. And if you have newer credit cards, it's okay to close those, because closing out the newer credit cards actually raises the average account age. If you have 4 credit cards, 3 of them are 10 years old and 1 of them is 1 year old. If you close out that 1 year old card, now your average account age is 10 years. But if you keep those cards, and let's say you keep the 1 year and you get rid of one of the 10 years, now you have 21 years across 3 cards. You have 7 years of average age across those cards. And so it's very important that you keep in mind the average age of your cards and which ones are the oldest and which ones are the newest. It's also very important that you keep track of this, because a lot of the credit card companies like to free up the credit that they're giving people if they're not spending on it. So every once in a while, $5 payment or a $5 charge on a credit card will keep that card open. But if you just like shred the card or put it in a cabinet somewhere or in a drawer somewhere and leave it, in about a year or two, they might just close the card on you, and that can have devastating results on your credit score. So, keep maintaining that card, those older cards, make sure that you keep them going, and that'll help you with your credit score. So now that we've talked about the rules for handling a credit card properly, let's talk about paying off the current debt that you have. And I'm making the assumption here that you have credit card debt, because according to Experian, the average credit card debt of a 40-year-old is $7,000. That doesn't sound like a lot. It really doesn't. But when you keep in mind that the average salary of a 40-year-old is $54,000, it really puts in perspective that $7,000 number. So what do you do if you already have credit cards that are maxed out and you're carrying a balance every month? First, it's really time for you to knuckle down on a budget. If you don't have one already, see my video here, and you can see some details on how to build a budget. Your budget's going to be the starting point for everything going forward. So make sure that you actually work on building a budget. Second, make a spreadsheet. List out all of your credit cards, what their minimum payment is, their interest rates, and their current balances. That's going to tell you exactly where your money is owed, how much it's costing you to keep servicing those credit cards, and it's going to tell you exactly where you want to spend your money to pay down the debt. Once you know where your debt is owed and how much it's costing you, you can start to form a plan for paying it off. There are 2 different ways that you can approach paying off your credit cards. They're known as the snowball and the avalanche methods, because I don't know. The people that came up with those ideas don't live in the Northeast like I do. I hate snow. I used to love snow. You don't love it anymore after you've had to shovel it quite a bit. So anyway, the snowball method focuses on paying off your smallest debts first. There's pros and cons to both of these methods. The pro for the snowball method is that it has a really immediate psychological effect. The psychological effect is basically that because you're paying off the smaller loans first, you're able to pay them off faster. You get to see results faster by seeing those debts paid off earlier. And that means that if you're someone who needs to see results quickly in order to stay pumped about paying off your debt, the snowball method will provide that. The con is that because you're paying off the smallest debt and not paying any attention to how much it's costing you to actually maintain that debt, it's going to end up costing you more over the course of paying off all of your debts to actually pay them down. It's going to take you longer to become debt-free. It's going to cost you more to get there. Now, the avalanche method focuses on paying the highest interest rate debts first. And the pro for this is twofold. One, it saves you money over the course of the long term, because you're paying the highest cost debts first, and therefore you're racking up less interest over the course of your pay down. And the result is that less interest is accruing, and therefore you're paying less in interest over the course of your repayment. And second, if you have a large amount of debt, you can actually end up paying off the entirety of the debt faster because of the fact that you're paying less interest over the course of the life of the debt. The con is that there's no instant gratification. You're not going to start the process and pay off one of your debts in a couple months like you could with the snowball method, and because of that, it takes more discipline to stick with it since you won't see those results as quickly. But honestly, I'm a fan of not paying more than I have to. It's just, it makes sense to me. If I have two options, one is pay more for the same thing, and the other one is pay less for the same thing, I'm going to choose pay less for the same thing. It makes more sense to me. So what do you guys think? Would you rather pay off your lowest balance debt first, like the snowball method says, or pay off the higher interest rate, like the avalanche method? Let me know in the comments down below. Third, look into balance transfer cards like I mentioned earlier. If you are one of those people that needs to see some instant gratification, but also doesn't want to pay more than they absolutely have to, this is a great way to hybrid the two, to hybrid the snowball and the avalanche methods. If you use one of the balance transfer cards, you can actually transfer a large chunk of the balance off of your highest interest cards onto this 0% interest balance transfer card. And by doing that, then you leave a much smaller amount on the highest interest. And when you end up paying that off, it gives you the immediate trigger, hey, I just paid off the credit card. Even though technically you moved most of it off onto a different card, it still gives you that psychological feedback of, hey, that card's paid off. So it's a great way to kind of hybrid the two. And this is a great way to reduce the cost of carrying those balances on the cards too. If you transfer a lot of the balance off of your high interest cards and now you're not paying any interest on it, not paying any interest is better than paying off stuff that's higher interest first, because I would rather pay no interest at all on a large chunk of change than pay a little bit less interest by paying off this larger interest debt faster. It's really helpful in the two regards. One, you're saving money, and two, you are getting the instant gratification of paying off one of the cards. Now that we have all of that out of the way, how do we do this? Well, once you have a budget, you know exactly where your money's going. You know how much money you're going to be spending on your rent. You know how much money you're going to be spending on groceries, on clothing, and all of the necessities. And now you know where your disposable income is, your money that's not already tagged to something that's essential for you to live. You can take the amount of money that you have left, figure out how much you want to budget for paying down your debt. I mentioned before that credit card minimums are absolutely the worst thing ever. But in this case, it's actually very important to only pay the minimum on most of your cards. So now that you have that spreadsheet of all of your credit cards and what their minimums are, you can total up the minimum payments for all of your cards, take that amount, and subtract it from the money that you're using to pay down your debt. And that'll let you know how much you have left over to put towards the highest interest debt. The more money that you have left over, the better, because paying down debt is probably especially credit card debt, definitely credit card debt, because it is the worst type of debt. Paying it down as quickly as possible is the best way to use your money. And the reason why I say that is, you might put money into your 401k, or you might put money into your IRA, and you might put money into your brokerage account or your HSA, but you're not going to be making 24.99% on that. There's no way you're going to make that much percentage unless something happens and the entire economy just blows up and goes sky high. There is no way that you're going to be making 24.99%. However, by paying down your credit card, you are locking in a 24.99% gain on your money. And that's just the way that the math works out. If you put $100 into a 24.99% credit card, you're saving yourself 24.99%, $24.99 every single year that you're not paying on that credit card. You're locking in a 24.99% gain by paying off that card. Use all the money that you have left over to pay the highest interest rate credit cards off in full. And then once you've knocked that out, go to the second highest and the third highest until you have no debt left. And this will let you pay the least amount of interest and therefore pay off your debt faster. And when you're debt free, you can then use that money for your 401k or your IRA or your HSA. You can put it towards your retirement. And that is the goal. All your money towards retirement that you can get. So finally, once you've paid off all of your accounts, don't break the rules. Don't break them. They're written in stone. They came down from the mountain. They came down from the mountain. If you use the credit cards in the future, pay them off every month in full. Make sure you don't spend any money that you can't afford to pay off. Don't pay interest or worse, late fees. Don't ever do that. I hate late fees. I hate fees, period, but late fees especially. Late fees are your fault. If you're not paying on time, the late fee is your fault. It's not the credit card company's fault like interest is. Interest is entirely the credit card company's fault. Late fees are yours. So don't pay late fees. Finally, don't close your oldest credit cards. We already discussed that. We don't want our average account age dropping. We don't want our credit score dropping. And this will ensure that you have paid off all of your debts, you keep them paid off, and you can get the added bonus of building your credit score. So when you go to buy a house or buy a car, you get the best interest rate you could possibly get on those loans. If you like this video, please click the like button. And if you don't, click the dislike button. I won't hold it against you. Subscribe and click the notification bell to join my crusade. It'll help my videos get more visibility with the YouTube algorithm so that more people can benefit from what it is I'm sharing and what I've learned that's working and what doesn't. And I can help others who, want to catch up to where they should be for retirement. Thank you guys for watching another installment of MiFi Crusade. I'll see you guys next time.